Hello everyone. By this point, you understand why stock prices go up and down. You know that prices move because of supply and demand, expectations, information, and human behavior. Now we're ready to explore a concept that often confuses beginner investors, and when misunderstood, leads to some of the most common investing mistakes. That concept is volatility. Volatility is frequently described as something dangerous, something to fear, or something to avoid. Headlines use it as a warning sign. Market commentators treat it like a problem. But volatility is not what most people think it is. In this video, we're going to explain what volatility actually means, why it exists, how it affects investors, and how it fits into long-term wealth building, not just in stocks, but in all types of investments. Understanding volatility is a turning point. It's the moment investing stops feeling chaotic and starts feeling logical. So what does volatility mean in investing? Volatility refers to how much and how quickly the price of an investment changes over time. An investment with high volatility experiences frequent or large price swings. An investment with low volatility tends to move more slowly and steadily. Volatility does not describe direction. It does not tell you whether prices are going up or down. It only describes how widely prices fluctuate. This distinction is critical. A volatile investment can go up significantly, down significantly, or both. Volatility is about movement, not outcome. So why does volatility exist in financial markets? Volatility exists because markets are forward-looking and uncertain. Prices reflect expectations about the future, and the future is never fully known. As new information becomes available, expectations change, and prices adjust accordingly. Volatility increases when information is unclear, outcomes are uncertain, opinions differ widely, and when emotions are heightened. Markets are constantly processing new data. Volatility is simply the visible result of that process. So why do beginner investors often fear volatility? Beginner investors often associate volatility with danger because price movement feels personal. When prices fall, it feels like something has gone wrong. When prices rise quickly, it feels exciting, but unstable. This emotional response is natural, but it leads to a misunderstanding. Volatility feels like risk. In reality, volatility is not inherently harmful. The discomfort comes from uncertainty and lack of context. Once investors understand what volatility represents, fear is replaced by perspective. So how is volatility different from risk? One of the most important distinctions in investing is the difference between volatility and risk. Volatility measures price fluctuation. Risk measures the chance of permanent loss or failure to meet goals. An investment can be volatile but not especially risky over long periods. Conversely, an investment can appear stable while carrying significant hidden risk. Confusing volatility with risk causes investors to sell during temporary declines, avoid growth opportunities, and misjudge long-term outcomes. Separating these concepts is essential for disciplined investing. So why do volatile investments often offer higher returns? Volatility and potential return are often connected. Investments with higher volatility usually involve greater uncertainty. Because many investors are uncomfortable with uncertainty, they demand higher expected returns as compensation. This is why growth-oriented investments tend to be more volatile, emerging industries experience wider price swings, and early-stage opportunities fluctuate more than established ones. Volatility is the price investors pay for the possibility of higher returns. So why does volatility increase during market stress? Volatility tends to rise sharply during periods of uncertainty. Economic slowdowns, financial crises, geopolitical events, and unexpected shocks increase disagreement about the future. When investors reassess expectations rapidly, prices move more aggressively. Higher volatility during these periods reflects heightened emotion, reduced confidence, faster decision-making, and shifting risk tolerance. Volatility does not mean markets are broken, it means uncertainty is elevated. So why do some assets have more volatility than others? Different investments have different volatility levels because they respond differently to change. Factors that influence volatility include business maturity, industry stability, predictability of cash flows, sensitivity to economic conditions, and market participation. Investments tied to innovation, growth, or change tend to be more volatile. Investments tied to stability and predictability tend to fluctuate less. Understanding this helps investors choose assets aligned with their goals. So how does volatility affect investor behavior? Volatility tests discipline. Sharp price movements often trigger emotional reactions, which can cause fear during declines, overconfidence during rapid gains, and an urge to act when no action is needed. Most poor investment decisions occur during volatile periods, not during calm markets. Learning to tolerate volatility is a learned skill, and one of the most valuable in investing. So how do long-term investors view volatility? Long-term investors expect volatility. They plan for it rather than react to it. They understand that volatility is normal, markets move in cycles, and that temporary declines do not define long-term outcomes. Rather than avoiding volatility, long-term investors structure portfolios and strategies that can withstand it. Volatility becomes background noise rather than a signal to act. So how does time change the impact of volatility? Time is one of the most effective volatility managers. In the short term, price movement appears random and dramatic. Over longer periods, the impact of volatility diminishes as trends emerge. Time allows businesses to grow, markets to recover, compounding to work, and temporary disruptions to fade. This is why long-term horizons reduce the emotional and practical impact of volatility. So how do investors use volatility to their advantage? Experienced investors understand that volatility can create opportunity. Price swings can reveal mispricing, create entry points, and allow disciplined investors to add exposure at favorable levels. This does not require predicting short-term movements. It requires patience, planning, and emotional control. Volatility rewards preparation, not reaction. So how can avoiding volatility hurt long-term results? Some investors attempt to eliminate volatility entirely by avoiding growth-oriented investments. While this may reduce short-term discomfort, it introduces long-term challenges which may include lower expected returns, reduced purchasing power, and difficulty meeting financial goals. Avoiding volatility is not the same as managing risk. In many cases, it simply shifts risk into other forms. So how should beginner investors think about volatility? For beginner investors, volatility should be viewed as a normal feature of investing, a sign of uncertainty, not failure, a test of discipline, not intelligence, and a long-term companion, not an enemy. The goal is not to predict volatility, but to prepare for it emotionally and strategically. When expectations align with reality, volatility loses its power. So why is volatility essential to wealth building? Without volatility, markets would not offer meaningful opportunities. Volatility creates price discovery, opportunity for growth, and compensation for uncertainty. Wealth is built not by avoiding volatility, but by remaining invested through it. Understanding volatility turns discomfort into confidence. Volatility is not a flaw in investing, it is the mechanism that makes investing work. It reflects uncertainty, disagreement, and change. It challenges emotions and rewards discipline. And over time, it separates reactive behavior from intentional strategy. When investors understand volatility, they stop asking, "Why is this happening?" and start asking, "Does this change my long-term plan?" That shift in thinking is essential for long-term success. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.